Private money focuses less on the borrower. We don't really care about your debt to income. We are an equity-based lender. Is there enough equity in this deal that if it goes south and we had to foreclose on it, could we easily liquidate our capital?
And sometimes the best thing when we talk about investing is you have to just cut your losses, cut them quick, keep them small, and that allows you and affords the opportunity for you to let the winners run.
Private money lenders and traditional lenders don't want to foreclose. That is like their last option. They would much rather work with a borrower, be flexible, modify terms, because the cost of it, that process is a longer process that keeps up the collateral tied up longer.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Okay, so talking private money, or what people call hard money, it's really just that non-conventional loans that don't come from a bank, right? Fair analysis. So there's sometimes, like when you start talking private loans, private credit, however you want to define it, there's a lot of misconceptions about it, both good and bad. And you've been in the mortgage industry for a long time. And you've been around real estate and real estate investing a long time. You've worked with a lot of home builders, more production builders, people building spec homes one off. And you've become familiar with what is private money, how does it operate, and what are the use cases for it. And so, like, kick us off. Why in the world would somebody ever borrow money from private money where the fees are sometimes higher, the interest rate is almost certainly higher, right? So there's a heavier cost, and but everything's kind of fine. They might, like, why do they even
why a more expensive loan might still make sense?
Yeah, right.
Yeah, I get it. It might help if I kind of start with a little bit of an overview of my background. I've been originating traditional mortgages for just shy of 20 years. About 10 years ago, I sat down at lunch with a builder I was working with at the time, and I asked him a question about noticing all of his payoffs on the construction loans that we were working on. So I was doing the long-term loans for the clients, putting the 30-year mortgages together at the end of construction. And I asked him, like, why aren't you using credit unions and banks for your construction loans? Private LLCs and individuals are more expensive, right? Like, so why not? The conversation that took place at that lunch totally changed my paradigm that there is a need for private money in the market that banks are not fulfilling. So first off, there's a need there, and that's why. And then he was able to sit down and kind of go through some of those pros and cons. Well, that was kind of my gateway to the industry. So couldn't stop thinking about it after that lunch, and called the guy back about a month later and said, hey, if I was to raise enough capital to fund one of your construction loans, would you use me on one of your coming deals? His response was, absolutely. You're doing the pre-approval, so you're assessing your own risk on the takeout. And then B, you'll stop calling me every 2 weeks asking for construction updates because you're going to be out inspecting the property yourself, right? So he looked at it as a win-win, and I had a couple rental properties at the time, so got lines of credit and kind of pooled some money together enough to do my first deal, kind of scraped it together on the first one. But that's kind of how I got into it. What's interesting is what a lot of people don't know about traditional mortgages is banks will originate a loan, and then they will turn around and sell it in the secondary market. Mm-hmm. When they sell it, they're making a profit. Well, if that loan gets paid off in a really short window of time, they will get hit with what's called an EPO, or an early payoff penalty. They basically claw back all of the money that they paid above and beyond principal for that note. So if there's a risk of a loan being short in nature, being paid off really, really quickly, banks and credit unions don't want to touch them because there's no profit. If they originate a loan and put all the time and effort and energy into getting it closed, and then 3 months later, the profits pulled back from the bank that pulled it, that's the need, right? There's a need there that if there's loans out there that are going to be short-term in nature, they probably should go more of the private angle rather than your traditional banks.
So like, why doesn't a traditional bank just figure out how to be a little bit nimble and say, okay, this is, we're a community bank. This is somebody in our community that builds homes will, fund their construction deals when they're building houses or, trying to, do a flip or remodel, rehab project, whatever. Like why do banks get caught up on not being able to just be nimble enough? I understand why the JP Morgans and the Wells Fargos can't do it, but the community banks and the credit unions, what's preventing them from being more nimble?
And I haven't worked in the bank and credit union arena, but I know there's a lot of compliance and you're trying to streamline as much as you can. So when you get a bunch of these one-offs, it becomes a time suck and less profitable. There are some banks that will call them a portfolio loan. They're going to originate it and they're not going to sell it. They're going to keep it on their books, or a balance sheet loan. They're going to keep it. You just don't see that very often. You'll see a few small credit unions do it, but even the bigger credit unions have gone away from that. So I can't speak real intelligently on why they don't do it, but I just know they don't, right? And that creates an opportunity for me. So something else I want to highlight with what you said earlier, you've got traditional loans, then what I would call a private loan, and then hard money.
Okay.
Hard money is usually higher risk. There's less equity. It's just a higher level of risk. Okay. And I operate kind of in that in between, calling it private money or soft money. I've also heard it called that way. Yes, the interest rate's a little higher. Yes, the closing costs can be a little bit higher. But because of the equity position in those type of transactions, the risk is still really low. And so it's I don't know.
Your perceived risk, at least.
Yeah.
Let's talk about risk. So like, what's the risk to the lender? First off, how is somebody that's deploying capital looking at a deal and saying, I feel good about borrowing this money to Joey off the street here, So when it comes to private money, I'll compare it to the way that the industry analyzes and decides whether they're going to fund a traditional loan, your typical 30-year fixed. Yeah.
They are doing it off of analyzing the borrower's ability to repay the debt. So they want to know what's your track record of paying debt with credit scores, right? Okay. What is your current income streams? How stable are they? Are they trending up? Are they trending down? Like, do you have the ability to continue month after month cover this debt?
Yeah.
And then also down payment assets. What reserves do you have to help carry? Private money focuses less on the borrower. We don't really care about your debt to income. We are an equity-based lender. Is there enough equity in this deal that if it goes south and we had to foreclose on it, could we easily liquidate our capital through a fire sale, right? Or a short sale or whatever. So the two totally fundamentally different platforms on assessing risk, and private money is equity focused.
Okay.
Collateral focused.
Yeah.
Yeah. So
what's the big use case then that people come up with where they want to go engage that kind of thing? Because obviously you don't want to buy a home permanently, right? Like if you're looking to buy a new home, you're not going to go out and say, well, I don't really qualify at the bank. I'm going to go get, soft or private money for, my 30-year mortgage, and hopefully I'm going to make some good payments.
The kind of ideal client, the very common kind of scenario that we end up funding deals on are people who own a home. They have a ton of equity in it, but it hasn't sold yet.
Okay.
But they want to purchase and not have to wait for the other one to sell. So we closed on one not too long ago. A guy in California owns a home with a ton of equity. We're talking $2-3 million worth of equity in it. Wants to buy a home here in St. George and move. but he lived in that house in California for 30 years. So the real estate agent that he was working with there said, hey, it would be way better for you to be able to move, kind of declutter. Then we can stage the house. It'll show better. You'll get a better dollar amount for your home. But he needed the equity to be able to buy the house in Utah. Well, we put the deal together knowing that we'd be able to fund it, get him into the house. The agent would then, within a couple of months, list the home. And our goal and hope would be within 6 months, that home is sold and we're paid off in full. So
talking risk to the lender, how do you analyze that deal, right? If you're buying somebody the home here on the IOU that, hey, I'll sell my house in California and pay you back.
Yeah. So we would analyze both the property that they're purchasing and the property that they're selling. Make sure that a term that many are not very familiar with is cross-collateralize. So it's really common in commercial loans where you'll have one loan, but you've got multiple properties attached to it. And so it's a little bit harder to do that when you're crossing state lines because you're dealing with different statutes, different regulatory issues. But if both properties are, say, in Utah, we will cross-collateralize, and that way we'll look at the appraised value or value of both of them, right? Divided by the total debt on, if we're doing 100% financing on the new purchase, what's the equity position or debt load on the one that they're selling? And so we kind of do a combined loan to value with the two properties. And if that fits within our risk threshold, we'll fund it every day because we don't care which home gets sold. We're collateralized.
So you're protected by potentially, like, if this, if the borrower loses the ability to pay or, close out, you're going to foreclose on both properties.
Yep.
So a borrower potentially loses both homes.
Yeah.
And that's probably a really rare circumstance, I imagine, avoided largely through prudent underwriting, I would expect. But it maybe one of the questions, like, I always hear a lot of misconceptions, just using a different kind of a totally outside example here. When people die without like an estate plan, they say like, oh, the state will get all your money, and that's like, it's totally not true, but that's a misconception. So in this case, if you sell both properties and say, there was, each home was worth $500,000, they didn't owe anything on the first house, but they've got a $500,000 mortgage on the second home. That extra $500,000 in equity, does that get retained by the lender that foreclosed on the properties then, or does the excess get returned back to the borrower?
Repeat that again. I lost you somewhere in that.
So if you have to foreclose on properties, right, and it as the lender, do you sell the property and make yourself whole and then return the excess to the borrower, the original borrower, or does it just become, additional compensation and to you for taking all the risk and dealing with all the headache?
It's probably good to kind of go through what is the foreclosure process, right? Okay. First off, private money lenders and traditional lenders don't want to foreclose. That is like their last option. They would much rather work with a borrower, be flexible, modify terms, because the cost of it, and it's a time value, right? It's not necessarily just the dollars and cents of the attorney fees going through the process. That process is a longer process that keeps up the collateral tied up longer. So we have had to foreclose on deals. We've taken short sales on deals. But the foreclosure is the absolute last resort. We are going to try to resolve it in any other way possible. So that's first off. Like, some people think, oh, private money lender, they're just waiting for that balloon date to come so they can start the foreclosure process. Not the case. That's a huge misconception.
Yeah.
But when you do foreclose, when someone's late and they're past the balloon date, a lender is going to file a notice of default on the county, and it kind of makes an awareness there of, hey, you're in default and we're starting the foreclosure process. There is a waiting period that has to take place, and a few other steps that attorneys have helped us kind of navigate in the past. But I can't remember there's a 90-day period that has to lapse, basically giving an opportunity for the borrower to make the lender whole, to get caught up on those payments.
Yeah.
Then the home will eventually be sold on the courthouse steps, and the one who has the loan against the property will issue what is called a credit bid. That's basically where the bid starts in the auction. And the bank can make a decision on, hey, are we trying to recoup all of our principal and all of the accrued interest and have a fairly high credit bid? Or if this is one, we don't actually want to own this property, we want someone else to buy it on the courthouse steps. So they start their credit bid as a strategic move, right? Lower, knowing that they're going to have to take a little bit of a haircut.
Somewhat authorizing their own short sale at that point.
Yep. I'm glad that I've had to go through the foreclosure process because it helps me analyze that scenario a little bit better. If I was to go back on one of the homes that I foreclosed initially, I by the way, I did not want to foreclose then either, right? It was a last resort. Had a borrower that just ghosted me. Months went by with us trying to make contact and follow up, like what's going on? Why isn't it being paid off? Ended up foreclosing, but there was a lot of costs that I was not prepared for with getting the home ready to be listed, right? All the utilities now are moved over into my name. Now you're paying real estate agents for a listing agent and a buyer's agent to help move the property. You start looking at all these costs, might be just better to start with lower credit bid. And walk away. The next day you have a check and you walk away. So,
there's an opportunity cost of carry on the capital not essentially working, right? So
yes,
even though it can feel a little salty to take a lower bid, if you have $1 million that's tied up and, you're hoping to get $1,020,000 or something, but it's going to be 2 months from now, that's less productive than, if you were able to just roll the, roll the million into the next deal, making, 10-12% on the money.
100%. And I don't think I would have ever known that as a private money lender without going through the process and going, oh, I know now how to assess those decisions much better if and when I have to do that again. Been lucky that it's been years since we've had a foreclosure that we had to go through. But so say we issue a credit bid and no one else shows up on the courthouse steps to outbid the credit bid. Then the bank literally the next day, the lender takes ownership, right? So a deed is recorded, a document recorded where they officially own the home. So in answer to getting paid back your loan and then having a surplus going back to the borrower, not the case. The ownership of that title and all of the equity is now the lender's.
It is now the lender.
Yep. And usually there's not enough equity in the deal. Like there's a reason we foreclosed is they're not making payments, which means between the accrued interest and everything, there's probably not a lot of meat on that bone.
Well, and I guess the thing that I've always noticed is that usually people that feel they're getting to take advantage of in these situations, oftentimes it's that their perception of what they own or have is actually the misplaced conception. It's not that the financial system is taking advantage of them. That's just their scapegoat in their emotional way of dealing with the situation potentially.
Yeah.
And I think so what you've highlighted is that's somewhat evident because if your credit bid was $800,000 as the lender and somebody came and bid $1 million, the other $200,000 would still go to the homeowner at that point, right? So the excess would go. But if you stick it on the bank at credit bid or the lender, whoever, then that's what the place was worth.
Yeah.
Because there was no one else in the marketplace willing to pay more.
Yeah. And a lender can do whatever they want on the credit bid. If they feel like there's a ton of equity in it, they'll bid it out because they want to keep it. They want to retain it, right?
Yeah.
But it's.
I don't think you see that a whole lot.
Yeah, it's a fundamental difference in banking, right?
Yeah.
When a loan is performing and receiving interest payments, right? It's an asset.
Yep.
When the loan is no longer receiving interest payment, they consider it a debt or a liability.
Yeah.
So they want to get rid of that as fast as possible. And that's why you'll usually find more of the let's go with a lower credit bid and just walk away. Let someone else who shows up to the courthouse step get a good deal, but you get to walk away and start putting that money back into an asset that's performing.
That's always the thing I find interesting about the real estate market in general, is that it's one of those still rather inefficient markets where the little guy can come in and exploit an inefficiency because it's such a segmented market that's so unique to its own microeconomic conditions, the local community. Who knows who? Do you have a good handyman to help you fix things up? Or do you have the right connections in the community to get something past city council to resolve whatever is kind of clouding the property? Whereas, for as much attention as home ownership gets by them being owned by, Blackstone or these big firms, like Wall Street doesn't have the time and energy to find all these tiny little inefficiencies and exploit it. You can't do it remotely the same way. Like real estate really is that hands-on in-person business sometimes. And so I think that's where banks or lenders rely in these cases on saying, there's going to be some scrappy wholesaler guy that wants to come bid on this. He'll find a way to get the funding, and he's going to find a way to get the place fixed up and turn it around. So we walk away, we lick our wounds a little bit, and we leave a little bit of meat on the bone for somebody to come in and exploit that inefficiency, but make a profit for themselves. And that's kind of the way real estate investing, that's the way that world kind of works.
Yep. Well said. To kind of expound a little bit on the type of deals we fund, I described a true bridge loan, right?
Sure.
Someone selling a home, but they want to purchase first, that scenario. You got flippers. Flippers need money to acquire the property, and then they generally need a little bit of a hybrid budget to help fund with some construction costs. We get hit up to fund courthouse steps, because when you bid, you got to turn around and provide a wire within 24 hours.
Yeah.
And so we get hit up on funding those, right? Which your typical credit unions and banks don't want to touch. And then we also do a fair amount of construction loans. The borrowers who are getting construction loans are generally not your consumers. They're usually builders. Builders that are doing specs. Banks don't typically like specs the same way they do on a pre-sold consumer-based, loan. And banks are they're time consuming. The paperwork, to get a loan from start to finish is going to take anywhere from 2 to 4 weeks, where we get a call from a builder, we can put a loan together in 2 to 3 days. So, we have a lot of builders that are willing to pay that little bit of higher interest rate for the flexibility, and speed, that we offer.
Helps them just get things moving faster through the production cycle.
Yeah. Well, I was telling you that initial builder that I was talking to at lunch, right? Part of his explanation on why he uses private money instead of banks and credit unions, he said, yeah, it's more money in the way that you're calculating it, but it's actually cheaper for me because I can manage a dozen private money transactions by myself. But if I had a dozen transactions going through a bank, I got to hire an employee to help manage that.
Yeah.
Then you add their benefits and wages to the equation, and all of a sudden it's actually more expensive.
Yeah.
It was a perspective that again, my paradigm was shifted on, like, oh man, private money deals don't mean there's more risk. It just brings, you're just catering to a convenience factor, right? Convenience and speed.
Kind of goes back down to that, what I was just highlighting, that real estate is that inefficient segmented market. And at the end of the day, even if you had a large, private credit company try to roll out, these bridge loans and small construction loans and stuff, by the time they put all the systems in place for their checks and balances and the compliance checks and all this, they run into the same issue that the bank kind of runs into. And so you need, in your case, like, you need someone that's on the ground in the community and says, oh, I know, Joe, and he builds, roughly 15 homes a year. He's been doing it for 10 years. And I see him at the grocery store, and nice guy and honest. And we got a relationship. So I can turn around his loan in 2 days and get him funding right away. And by the way, I already have his information on file. So I know right where I need to send the wire so he can start getting it. And then, he knows my process for how I inspect on draws. And it's just really quick and easy. You can make some nice relationships in a community that otherwise, like credit unions, again, it just sounds like they look at it and say, we'll leave that to you guys because they're more focused on the consumer loans, the auto loans, the checkings and savings accounts, credit
juice
cards.
isn't worth the squeeze, right? Yeah. It's just the time and money that it takes to put those systems versus the income they're going to generate from them just isn't worth it. Where a private money lender who can be kind of tailor make stuff, tailor make a loan to the actual risk of that particular transaction and not try to put it into a matrix of guidelines of getting something to fit in a box.
Well, I found private money is expensive, but not that much more expensive, right? Mm-hmm. So the difference that I see it making is like, even if a credit union tried to be nimble or a small community bank tried to be nimble, by the time they add just a couple extra people, a couple extra processes, in order to maintain their profitability on that loan, it's going to have to be a little bit more expensive than current private money rates probably. And what I found is that hard money rates and private money rates, they tend to push the envelope a little bit on what is feasible, right? Like if it got a little bit more expensive, especially with interest rates already where they're at and the equity valuations on real estate or the market valuations on real estate being where they're at, it's like if you had to originate at 15 or 16%, it would be too much. Yeah. The project wouldn't pencil, right? So if you had to push it a little bit more than where it's kind of currently at, stuff would stop penciling. So it would be a product, even though that they could now operationally handle it, the cost would be just high enough that I don't think it would pencil the same way.
Yeah. It's interesting. The knee-jerk reaction I get from people who are not familiar with private money but are inquiring about it, mm-hmm. You quote them a rate, 9, 10, 10.5%, somewhere in that range where you're seeing private money out there right now.
It's actually inexpensive private money.
Well, yeah. So we've got loans out anywhere between 9 and 11 right now. Most of them are between 10 and 11. And we feel like that's very reasonable because to go to any bank or credit union right now, you're probably between 7.5 and 8.5. So it's not a huge spread on the rate. But I bring it back to saying, yes, I understand your knee-jerk reaction, but rather than looking at it as rate, let's put that together in an actual number. Mm-hmm. Let's look at what is the interest rate that accrues daily. And if you're in this bridge loan that you might only need it for 30 days because your home might sell quicker than you think.
Yeah.
Or maybe you need it for 6, but you start putting that number together and go, oh yeah, the rate doesn't matter as much because the loan is so short in nature.
Yeah.
So once you kind of talk through that with people, they start realizing like, oh, that's only a couple $1,000 difference. Well, yeah. Would you pay a couple $1,000 more on purchase price of this house because you like it that much? And most people would say yes.
Yeah.
So
yeah,
it's just kind of how our minds work and how you frame it.
Well, we're behavioral creatures at the end of the day, right? I think one of my favorite behavioral thing to always go back to is Simon Sinek and his principle that like, we never make logical decisions. We can only use logic to try to justify our emotional decisions. Yep. And I run into that all the time with clients where it's a framing issue more than it is anything else, that we just understand things the way that we have understood them, but we don't necessarily understand them the way that they are, And so we have to look at things through different perspectives, new perspectives. And that's a really interesting way to think about that. I actually hadn't even considered before. Like, what would you have paid an extra $5,000 for the house if you really love it that much? Oh yeah, we would have offered 10, 20,000 more. It's like, well, there's a little bit of cost, and that's why I'm not an advocate for people moving every year, because there's a lot of friction cost in transacting in real estate.
And take that same scenario a step further. The house that they're vacating, if they can move all their personal belongings out of it and have it staged right, could you get $5,000 more out of an offer on that house?
I leave that question up to the likes of Jeff and Rob.
But you see my point, right? Like it's just making sure we're looking at it from all perspectives. I will be the first one to say private money transactions aren't for everybody, and it's not for every transaction.
Yeah.
But it can be such a tool in a lot of one-offs.
Yeah. What about remodels? Do people ever, call on soft money for remodel? Like, hey, I'm gonna buy a house, and maybe they qualify for a conventional, or they have the ability to do a cash buy because they're moving from a different state and they have a bunch of equity, but they want to do like a major overhaul on remodel. Like, I'm not talking, new cabinets and a new bathtub, but, tear it down, move a wall, add the landscape and the pool, like a full.
Yeah. Yeah.
Did they ever reach out for something like that?
We generally don't we don't get hit up on those very often. And even when we do, I'm not looking to fund every deal that comes across our desk.
Sure.
I want to make sure that we are the right economic option for that scenario. And 9 out of 10 times getting a home equity line of credit with a local credit union or bank is going to be more economical. Now,
they're more willing to lend that because they already own the home. Mm-hmm. Right. In this scenario, that's the factor that really changed is that they own the home already and have a ton of equity.
Yep. So we did fund one where the home equity line is only going to be based off of the way that the credit union analyzes it, the way it is face value, right? Mm-hmm. What is it in the condition that it's in right now? Mm-hmm. Well, this gentleman wanted to pull the home equity out to do an ADU, which would then generate an income stream and that much more square footage, it's going to add value to the house. So we needed to do the private money note to get him to where he could increase that appraised value on the total property, but it would only come in higher once the project was complete. So, we'll look at those again, case by case. But one thing that a lot of people don't know about with private money, most private money lenders don't want to receive monthly payments. It's more of an accounting decision, right? We don't want to be a debt collector of collecting them. So there's a lot of people who are trying to sell that house, buy the new one, or do the remodel or the addition.
Yeah.
And they're worried about needing to make that interest only payment during the project. Well, you can make those payments once you have the renter move into that ADU, right? So we end up just letting the interest accrue. No monthly payments are due. Yeah. And at the end of the term, you'll have the initial principal that was borrowed plus accrued interest on the payoff.
Yeah.
So your payoff's going to be higher, but that's another little value add that might fit with people who are a little bit more strapped, equity rich, cash flow poor, right?
Yeah. It's funny. That's exactly how the U.S. Treasury does it.
Yeah.
Seriously. If you buy a Treasury bill, which is like 12 months or less, they don't give you monthly coupon payments the way that they would on, well, they don't do it monthly, but they don't do like a semi-annual, coupon payment like they would on a 10-year note or a 20-year bond or anything like that. They just like, you buy it at what they call buying it at a discount. So you're going to buy it for less than $1,000 at a number that would represent, by the time they give you $1,000, say 6 months from now on a 6-month Treasury, it would be equivalent to you getting these interest payments of 4 or 5% along the way, right?
Sure.
This annualized out sort of idea. So that might be the one efficient thing I've thought of all week that the government does is it manage their accounting mess on Treasury bills like a private money guy. Yeah. Okay, interesting.
Yeah. So we've had people that have pulled the trigger on a private money deal just because, like, wait, we don't need to make interest payments. It reduces stress, right?
Yeah.
Needing to make 2 mortgage payments on the same income that you were making before, like that can stress you out.
It's a dangerous game though for borrowers, because I know that I've sat with people that had private money loans, and I'm like, you need to lower the price on your house and sell it. Like you need to discuss that with your agent and really consider that, because you're holding out for this current number. And if your home isn't worth that, but you're trying to hold out for it, realize that your exposure, if this doesn't sell in the next 6 months or year, like it can be anywhere from $30, $60, $100, $150,000, depending on the size of this, loan, and it's accruing up quick. So, but what I found is that people don't think about that because out of sight, out of mind. They're not cutting the interest payment every month, right? But if they've been cutting a check for $10,000 a month in interest, they've been like, they would have been thinking, well, we gotta settle this a little sooner, Yeah.
Right? And I have worked with people who have had private money loans that were coming to me to get a traditional loan to pay it off, right? Because I straddle both. I do both. Yeah. And so often people will come in and remember what the initial loan amount was. Yeah. And what's the amount? What are we refinancing? But then when we get the payoff, it comes in $20,000 more. So to me, I think it's also just really important for private money lenders and traditional lender to make sure that you're forecasting what that's going to look like on a payoff.
Yeah.
So they have an accurate picture of what it looks like at the end.
Yeah. What are some good questions people should be asking themselves or the person that they're looking at taking a private money loan from? Mm-hmm. And like, what I mean by that is there's so much stuff out there now that, because in this world, it's not, that's not regulated stuff, right? It's just, Johnny's got $500,000 in his checking account. He's going to borrow it to somebody that, do this. Like, is there an advantage to working with somebody that is going to borrow easier, or do you want to make sure that you're working with somebody that's got a lot of experience, the right documentation in place, or like what are the things you would want to maybe ask about as a borrower, as a
borrower trying to identify who you would use for a private money transaction? Yeah. Mm-hmm. I can't help but use the parallel of an analogy of a mechanic. I know nothing about mechanics. I know how to check my oil. I know how to change a tire.
Sure.
Right. I know how to jump a battery, but you start talking mechanics, that most of it's right over my head. I have to go off of someone who I trust to give me a recommendation. And then I got to go in with all trust, right? I think private money is the same way. You have to find someone who can vouch for that private money lender. Maybe it's a real estate agent working in the market. Maybe it's a title company who can vouch for them. That because you do have private lenders that are in it for them. They're looking at anything they can do to squeeze as much juice out of that deal. And then you have other lenders that are saying, no, we're here to help you solve a problem, mm-hmm. and we're going to make a little money along the way, right? We're in this as a partnership. The name of the company that we have, the private money company, is Yoke, right? The whole reason we named it Yoke is the idea of needing to have two oxen yoked together, working as a team in tandem. Mm-hmm. Them two oxen independent, not working together. A good borrower without a lender, that project is worthless. Mm-hmm. A good lender without a borrower, that money is worthless.
Yeah.
You have to work in tandem. So our whole fundamental basis of doing loans is we understand that there's a need that is not being fulfilled by the credit unions and banks, and we want to partner in this project where we both mutually benefit. But there's plenty of lenders out there that are like, oof, how can I squeeze as much juice out of this as I can, regardless of who pays for it? You get where I'm going with that. And it's your real estate agents, it's your title companies that will be able to steer you toward someone good or away from a name or two. Does that answer your question very well?
I think that's to an extent. But what about the scenario where you get, you talk to your real estate agent and they give you a name, and you talk to your title agent and they give you a name, and you talk to your mortgage lender and they give you a third name, and they're all different. Yeah, you're gonna take a meeting with them. Like, what are the questions that you can ask that helps you identify like who stands out, what are their practices, what are some concerns you would want to keep an eye out for?
Anyone who's got the social skills, you talk to someone, there'll be natural red flags that will come up. Mm-hmm. Transparency is big. Disclosing it, talking through best case, worst case scenario. I don't like the answer that I'm going to give you of you kind of got to follow your gut after having those interview, sure. conversations. But I would absolutely ask for a reference. Can I talk to a couple of people who have borrowed money from you before? A couple other clients? Absolutely ask for recommendations. And then ask, ask them if they've had to foreclose, if they've taken a short sell, and maybe talk to one of those clients and say, how workable were they?
Yeah.
When things didn't go as planned, how did they respond? Those are the type of things that I would want to know.
Just like, tell me about the stuff that hasn't worked out.
Yeah. Yep.
Yeah.
And if you have a private money lender that doesn't want to provide those type of contacts and referrals, then you should probably turn around and walk away. But I think reputation in town is huge. You're going to get enough people that when you start hearing the same name in multiple places, you're like, okay, that's probably who I should be calling.
Yeah. Well, I think that works a lot easier for real estate agents, maybe that are trying to build a relationship with somebody that offers this type of lending, but it's more difficult for the person moving to town from out of town, right? Or that out of town borrower, because they're not on the ground. They don't know a lot of people in the community yet, maybe.
Yeah. Yeah. And
it becomes trickier.
And that's valid. It's just tough because think about it. Where do you go to? There's actually quite a few private money lenders in town, but you wouldn't know it. There's no advertising taking place, right? There's no billboards. It's a business that is just done quietly.
Yeah.
And the ones who are the most aware of who offers them and what companies are actually closing deals are title companies. Title companies over real estate agents. They're the ones that are closing them.
Title companies always have the inside. They always seem to have the inside track on what's going on. They're the sleepers of the real estate agent. Everyone overlooks them, or not everyone, but so many people overlook title. Huge key component to almost every transaction.
So if I'm looking for a private money deal and I'm looking at a state in an area I don't know, I would tell you the first 3 phone calls would be, who are the 3 biggest title companies in town, and then I want to go talk to their busiest escrow officer. Just have a 5-minute conversation and probably walk away with some really good info.
And they'll probably know a couple people.
Mm-hmm.
Yeah.
Yep. And they would probably be able to tell you, I would, based off of your scenario, I'd use this one over that one, right? And if someone's scenario is a little different, that advice might be. So for me, our bread and butter, give you a little bit of background on how we assess our deals that come across our plate. I don't like big deals. Mm-hmm. I don't like loan amounts of north of $1 million. And a lot of that is I want deals that if I ever had to foreclose, is it the type of house that I could put a renter in there and be able to pay out my investors a dividend check? Like, that's my worst case in my mind.
Sure.
You don't do that with a $2 million house, but you absolutely do it with that $700,000 or $800,000 house that the builder had 20% equity in. And sometimes it will pencil better than others, but I assess the new construction deals that we fund is we want that mid-range home are the ones that we love to fund, because we feel like it's got a really good plan B and C if plan A doesn't go well.
Well, it gives you somewhat of a margin of safety.
Yeah.
Right.
And if you know anything about real estate investing, right, it's the smaller units give you better dollars per square foot cash flow, right? Or rents. And so all of that kind of plays into the thought process. But another private lender down the road might say, we don't want to do anything under $1 million. Like we have,
they just have a big enough capital position that juice isn't worth the squeeze.
Right. Yep. And so
we call those people banks.
Yeah.
Where I come from.
Yeah.
But
yeah. So yeah. Anyway, it's every private money lender is going to analyze things a little bit differently, and I think it's a big advantage for me who have worked for 20 years in the residential traditional world. Mm-hmm. It helps me assess things differently. I ask different questions that someone that hasn't worked in that field. Helps me prepare the exit strategies for borrowers, because it's very common that I'll help them with both loans.
Yeah.
So that's a little bit of a competitive advantage.
Would you care to share any stories about where you've seen borrowing private money go wrong for people?
Yeah.
Where like they could have done something different on the front side to maybe have gotten a better outcome, but they didn't, and they ended up with obviously a poor outcome.
It's I would tell you that scenario 9 out of 10 times is they move forward kind of naive to the full picture, right? There was a gentleman that I talked to. Come to find out, after we did the loan for him, he then tells me that he has a couple $1 million in a brokerage account that he probably could have gone and got a pledged line of credit or an S block, right? Borrowing against his stocks at a lower interest rate without any closing costs. I'm like, man, like who is that on? Is that on me not asking more questions for the borrower? Is that the borrower not being aware of those other tools that were at his disposal? So
that one's probably on the borrower or the borrower's financial advisor.
But you see what I'm getting at is it's one of those. It's usually I didn't know, right? I didn't know I could do that. I didn't know that was a tool that was available. And some people will move forward with a straight convenience factor. They know they're going to pay a little bit more, but then the house doesn't sell as quickly as they thought. And so now all of a sudden things are looking worse and worse every day, every week, every month that goes by as that loan's still in place.
The loan is basically eating into the equity as the home sits, right?
Right.
So they're going into it thinking, okay, I'll pay for the convenience, no big deal. And this thing should sell in 30 days. And I'm expecting net proceeds X, $80,000. But the home ends up sitting 6 months and they start biting their nails because what was supposed to be $80,000 is now an extra $50,000 in interest, income to the lender, and they're walking away with 30. And by the way, if they don't take this potentially lower ball offer, they're going to eat through, the rest of the 30. So now they got to lick a wound and walk away with 15 because they had to take that one offer that came in a little bit light and make a deal happen.
The scenario that we see with what you're describing there is actually on builders who are building specs. So they build it based off of, hey, here's what we anticipate the appraised value being based off of this square footage and these finishes. At the end of the construction, they list it for that price. It sits. It's not getting activity every day that goes by because there's no interest payments being made, right? That
Their
balance
profitability is shifting
growing
to the lender versus themselves.
Yeah. And then they have to do a price reduction on the house. So now they're getting sandwiched on both sides of the equity, right? Balance is going up as well as needing to sell it at a lower price. And then you get to the end of the term, private money lender is going to say, hey, we're at the end of the term. If you need more time, we need to do an extension. There's an extension cost. So your balance went up even more. Those are the ones that I think a lot of builders will look hindsight and say, man, we should have started off at a lower list price. Maybe we should have put some different finishes in the house. Maybe we should have finished that backyard rather, there's all the hindsight's 2020, with specs. So that's probably where I see people go, man, I'll do it a little different next time. Yeah. Is usually the spec borrowers.
Do you find that more and more people are doing specs are becoming more and more aware of that? So they're putting less features in the home and doing things that they're leaving more things unfinished that a homeowner could easily finish themselves, like backyard landscaping.
No, in fact, I think it's the exact opposite. They're actually, there's one builder that I do quite a bit of work with, and they had a few spec homes that were sitting. The listing agent that had those listings would call the buyer's agents that had walked people through homes and find out, okay, hey, well, you didn't make an offer on this house. Did your client go under contract on another one? Well, why? And then go up on the MLS and look at it. Well, how is it different? Yeah. Oh, shoot, this one had a finished backyard. This one didn't. We needed to put a little jewelry on the house to get it to move because there's more inventory that's growing. Yeah. So it's almost more like we should have done more up front.
That new construction inventory certainly seems to be growing.
Yeah. Yep. So it's I think that's the biggest one where people look hindsight, because on a bridge loan, it's a little bit easier to run numbers. It's a little bit, there's less variables. Okay. On construction, you're varying on your future price that's going to be sold, and you're hoping that the subs you're using, those prices are solid, right? That you're not going to be over budget.
Oh, it's the death of any construction project, right? Is over budget.
Yeah, most are.
Anything over the budget typically is just eating in profit margins. So
yep. I haven't had too many clients that we're like, oh my gosh, we'll never do this again, right? But it's usually we could have tweaked this or that, right? It's a series. It's a chain of decisions. It's not just the loan on the house that they're buying, it's the house that they're selling. There's just a ripple effect of decisions.
Yeah. Well, things become really emotional too once you're the person in the spot, right? So whether you're doing a spec home or fix and flip or whatever, right? Once you're the operator, it becomes emotional. there is an element of emotion, right? Going back to what we said earlier, right? We're just emotional creatures trying to justify our decisions with logic. And when you're in the driver's seat of that, it starts like you're feeling that pinch. There's there's hard money eating into it, but I got to fix that cost, but I got to get it sold. And, my home, all of a sudden you start getting the thoughts too, like, and it's just human nature, right? My home's worth more than the other comps because it's my house. I did the project. I did it the right way. This has the best, this has good bones, or this is done right, or whatever. People will pay for that. And at the end of the day, if they're going to pay for that, they are paying for that. And if they're not paying for that, then you got to gut check with yourself pretty quick and say, maybe I'm wrong. But who's not wrong is the hard money lender or the private money lender that's accruing the interest. He's going to get paid. So I need to make sure that I'm just navigating around that logically as much as possible. And, if you have properties you have to move them, and sometimes the best thing when we talk about investing is you have to just cut your losses, cut them quick, keep them small. And that allows you and affords the opportunity for you to let the winners run.
Mm-hmm.
Yeah. And that's where the magic happens.
Yeah. So. And anything with anything when it comes to lending, communication is so critical, right? If you're in a traditional loan and you're running into hard times, call your bank, let them know what's going on, right? Yeah. If they're just late payments and they don't know why, right? Mm-hmm. There's not a whole lot of empathy or sympathy to go there. Private money lending too, like you should be communicating with that lender as the scenario develops in real time, because the advice and consultation can pivot with your scenario. Yeah. Right? We've had deals that we've been 3-4 months in. It does not look like they're going to get sold. Well, great. We better start working on a refinance to get you into a lower interest rate, because you're going to be in this a little bit longer than what you think. Mm-hmm. You got to pivot to that plan B. Yeah. Rather than just, communication is just so critical.
Yeah. Ghosting people with the legal ability to foreclose on your property is usually not a great idea. Yeah. So I actually, I talked to somebody one time, and I can't remember what bank he was at, but he told me about calling his bank in I want to say it was late 2007. So for anyone that doesn't remember, the housing market was already unwinding 06, 07, right? Everyone thinks 08 was bad, but it was across the country. It was already starting to unwind. Properties were sitting, property values were coming down, right? It had already begun. And, it was late 07. He calls his bank and says I am not going to be able to make these payments the same way. And he, the way that he told the story, this guy was tearing up, and he said, this is a time when people were trying to call banks and no one was talking. They were saying well, too bad, yeah. And the guy was just really honest with them, didn't make up a story in this case, and just said look, I don't have a job and my family lives here and we want to do the right thing, but we're letting you know now that we can't as of right now. And he said this bank worked with him on it actually, and they were willing to help out, and they reduced his payment for a period of time. And anyways, I guess they worked with him. Mm-hmm. And the guy has never changed banks. He's I refuse to bank anywhere else ever the rest of my life. Just made a loyal customer out of him. He's at a time when no one could get anything done. I don't know. He's changed his whole perspective on everything in life. Yeah. That somebody just said oh, well, you're going to communicate with us. We'll give you let's see what we can do to help, And
I come back to one of the original comments we made earlier. Banks don't want to foreclose. The cost to them to go through a foreclosure, they are incentivized to be workable.
Yeah. Yeah. It's we got another story. I know of a guy that owned a bunch of properties going into 08 and kind of saw it all coming, and he saw it starting to unwind. Had a bunch of lots and stuff that he was going to be developing. And he walked into the bank and said, what kind of check do I have to write for you today? Yeah. To just own it. Yeah. And he was just trying to get out early, knowing that in a couple more months, maybe the bank's not willing to take this over, so easily. But he's I'll just default on them right now. I'll cut you a check to make, you know what I mean? Where can we basically short sell it? I want to short sell this to you today, basically to the bank. Yeah. And saved his
and think of the bank. The bank doesn't have to go through that, lengthy foreclosure process where their assets just tied up. They are able to shortcut it, and that's why banks will be make a deal on that one because they know the cost that's gonna accrue.
Yeah. Well, for anyone listening, don't take advantage of don't try to take advantage of your banks or your private money people. It will come back to bite you eventually, right?
Yeah.
But it's just, it speaks to communicating, right? Better outcomes always come from good communication, whenever possible. So.
Yep. Private money lenders are problem solvers. They're going to be looking at scenarios and saying, hey, how can we move the puzzle pieces around to accomplish, whatever the project is or the deal. So they're a little bit more on the creative side, and they're just good people to have in your back pocket to just bounce ideas off of. Yeah. So there's more value in just funding the deal.
Sure.
You should leverage their knowledge and the case studies that they've worked on.
I think that's some really good insight to wrap it up on. When you have people that see a lot of situations and see a lot of things, it's never a bad idea to give them a call and just bounce some ideas off. Usually people are pretty willing to talk, especially if you call and just ask with some humility, look for some advice. Yeah. So
thanks for sharing that. Thanks for having me on.
Yeah, we will, we'll see you around. And anyone that's looking to have more questions answered about private money, why don't you go ahead and email us, reach out to me, leave a comment, whatever it is, and we'll maybe bring Ben back on and maybe answer some targeted questions or answer in some follow-up episodes. So
happy to.